Hello and welcome to the Harwood Report for August 13th, 2018, presented by Trade Academy. I am Keith Harwood, the founder of Trade Academy. As a reminder, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Take a look through the rest of these disclosures to make sure that you are comfortable with what you're getting here. All right, guys. I'm going to go through the equity indices because there's some stuff going on there. But actually, my real main focus this week is kind of in gold. I'll talk a little bit about why here in just a couple minutes. And a reminder, if you want the actual trade ideas that I'm looking at, you got to sign up for the Harwood Report newsletter on the website there. So take a look at that if you want. It's got a couple weeks for free still, or a week for free now. Fear and greed's at 57 right now. This is overstating. I think that we're seeing real fear in the market. Where am I seeing real fear? The VIX. I'm seeing real fear in some of the general market metrics. When they call this extreme greed, I think that's ridiculous. It's basically trading at the midpoint of where it's traded over the last year and a half, or a year and change. So how is that extreme greed? Maybe relative to the last 2 months. That's not extreme greed there. This is not extreme greed. This is right in the middle. This is maybe showing some sort of greed, but it's low compared to recent history, but high relative to longer term history. So again, it's like longer term historical levels. None of this is showing that much extreme greed. Again, here, this is a flat line. How is that greedy? This actually should probably be marked somewhere greedy because we are seeing some higher levels there. And the VIX, I would agree that it's probably a little bit neutral overall, but a little bit high relative to the recent here. And then there's this extreme fear that I don't think is extreme fear. I think everything is very, very neutral on this sort of stuff. And then there's some fear out of, a couple of these other metrics. So I think this should be sub 50. It's just the way, though, that they do their calculation. It's very mathematically focused, excuse me. Let's go to the charts here. S&Ps are testing the 20-day moving average. That provided support all of 2 weeks ago, week and a half ago. So it's not really a major event yet. Breach that, and then maybe I think we can get a little more interested in the equity market as a whole. If anything, I'm looking for just kind of a stabilization today, tomorrow, and then start resuming that uptrend as the Turkish issue becomes less of a global issue and more of a independent issue. So I think that what we're dealing with right now is the question of whether Turkey and the issues that they're having end up creating bigger issues overall for Europe. If they don't create bigger issues overall for Europe, or if things start to get a little bit better with the lira, then maybe people get a little bit more excited. So, just so you guys can see what's been going on with the lira, in case you haven't been watching it, that's kind of been the big story for the last couple of days here. Let's do the lira versus the US dollar. There we go. And you can see that the lira is just falling out of bed. That's why the dollar is up relative to the lira, which is getting destroyed here. This is the cause of what the last 2 days of sort of pseudo-contagion we've seen is. That's been just destroying the Turkish market. And as a result, it seems like people are just kind of doing a little bit of risk reduction in U.S. stocks. If the Turkish lira can stabilize, if they can make some changes there via the central bank, maybe they can fix that, and then all of a sudden the market can go back to new highs. If it continues to fall out of bed, then people get really concerned. It's a similar story in tech, but tech's actually performing a little bit better than the overall market. This is kind of telling me a little bit more, I think, about the U.S. story. So even though, IWM has been consolidating, tech is still looking pretty good. IWM is actually looking a little bit weak today, which is a little odd, given that if this is a problem with Turkey, why would we sell the domestically focused small caps? Could just be a beta game where IWM small caps tend to have a higher beta than to the market. But, I think a lot of this is just kind of people trying to get a little closer to home, reducing a little bit of risk, not necessarily turning this into a collapse mode yet. Collapse mode occurs if and only if we start to think that Turkey will have a bigger impact on the global market, and it's not a big enough GDP country. It's like the same size as Netflix, I think I heard. So we're not talking about a majorly large problem, even if it starts to look like collapse. When Greece had its issues, did that destroy the world markets? Absolutely not. So I think that's what we just need to keep in mind here. Bonds as a flight to safety, they jumped a little bit, but it's really not that much. Vol is actually very cheap in the bonds, though. So that's one thing I want to look at. First off, VIX, you can see, is kind of coming up here. So you see the VIX, the volatility of equities is coming up. If I go to bonds, bond vol is still... We'll go to the volatility metric here. Over the last 6 months, this is basically at the lows in the volatility. So, if if there were a true global macro issue, I think we'd start to see it in global bonds as well. People need to go to the credit markets to try to figure out what's going on. And if credit markets don't have increased volatility, that may be giving us a little bit of a signal that a little of this is overdone. So that's kind of it there. Like, there may be a trade actually in the volatility landscape of bonds as a hedge for a bullish equity position if somebody was looking for something like that. I talked a little bit about that in the newsletter. I'm not going to give you guys specifics on it today, but I think there's something there that can be used as a portfolio hedge more so than just like liquidating positions right now that are, it's sort of an irrational behavior to liquidate something when there's something else I can do that will benefit me more, even if the market continues back to highs. There's a chance that, the TLT hedge to the equity portfolio works when equities run back to highs, or, it could just also work if the market starts to collapse. Let's go to the bigger story here, and that's, people talk about the risk on, risk off, and here's one spot for it, dollar yen. It's finally weakening a little bit. Yen is generally a safe haven of demand. And this oftentimes drives investor demand for gold. And yet, what have we seen today? Gold is collapsing. It seems like we've gotten to that point of capitulation where gold bulls say, if it doesn't work today, if it doesn't work on these pullbacks, why am I bothering hedging my portfolio? That actually sets it up to, I think, potentially spike and start squeezing. For those of you that ever look at COT, the commitment of traders, it shows the magnitude of speculative positioning. Speculative positioning is very light on the long side of gold and very heavy on the short side of gold. So if we start to see a rally, then people start to panic and think, I got to get back out. This was my buying opportunity. And then as we get up towards here, they're just scrambling to get out to make sure that they don't miss out on their winnings, or the people that are selling down here are getting squeezed out of a bad position. Note where volatility is in gold. It is coming up a little bit as a result of this move today. That's something to be aware of, that the standard gold skew is a call skew. It's coming up on a down move here. I think part of this is just people kind of doing the panic hedge of their gold position, or just pitching it, or just replacing it with options. And that creates that system set up to me where we may just see an absolute massive reverse in gold. Okay, so that's something to be aware of. And I think that the other one we all want to watch here is GDXJ, which finally collapsed. And yeah, volatility is expensive relative to where it was last week. Last week it was 17 or 19, and now it's up to 22. But if I go over, say, the last 2 years, 22 is kind of ridiculous for gold miners. So the problem with gold miners is, of course, the fact that there's a little bit of an equity component, and oftentimes it lags gold. It lagged on the break. It may not be the first to spike out of it. So something to watch, but I think that gold is the main focus for me right now, as opposed to the miners. The miners would be a secondary place to go and look at some longs, and I think that the volatility starts to come down in GDXJ if gold itself even starts to bounce. That can then hit the volatility here and create a better opportunity for an entry. So let me close this window here. We don't need that anymore. So gold, silver, all the same there for me. Much more interesting setups right now than the equity market, given that the equity market seems to be moving a little bit off of irrational fear of Turkey. And that may quickly flip trend. And so it's really hard to extend near the lows when the volatility marketplace has already come up there, and especially when there are opportunities elsewhere for better trades. Finally, the last commodity I like to look at is oil. So we look at USO, and you can see it's getting hit now. So we're getting into a little bit of sell everything mode. Actually, as we speak, spiders are on the lows of the day, small caps on the lows of the day, and oil is getting hit here. That should traditionally be a little bit bearish for XLE, but we've got a little bit of support here to work through first in the 73 range, 73.5 range. That may stall this. And again, if oil is the last thing to break, that might just tell us that oil is going to be one of the first things to come back out of it, that this was the irrational thing to sell, oil and oil-related companies. This is, to me, more of a let's take a look at the volatility landscape again, because if I look at XLE vol, which is up about a point now today, but it's dirt cheap relative to history. So if oil companies' volatility is cheap, and we're at a point where I could see it really easily going either way. This is another spot to look at a volatility-based hedge rather than in the overall equity indices. There's a little bit more of an opportunity in oil names as a volatility hedge or in TLT as a volatility type hedge. That's basically what I'm getting at there. So, my big opportunities, I think, are in volatility landscape for the oil names, the directional landscape of gold, volatility in bonds, and then waiting out a little bit of the equity markets to see what we're going to do first, because the VIX has already come up and put a little bit of a vol premium there, and so it's a little harder to find a really big edge. Okay? If you want to know more about how I implement those ideas, go to the Harwood Report. Link right here. I apologize. This is actually the first 1 week for free. I had to change that because I'm having some issues with my subscription service. That the price on this is $49 for now. It's not going to be $49 for long. I'm just having a little bit of a back end issue here, and I have to have my web guy fix it. So if you want in, you still get it for $49 after the first 1 week for free. So I'm going to just change this on here so you guys aren't telling me that I have to go back there and do anything there. So first week for free. All right. So the first week is free on this. And then after that, it's $49 a month if you get in now. Anybody that gets in after I get the change, it's going to be $97. If you get in it now at $49, you get to keep it at $49 for the duration of your subscription. So if you want the option to keep it for $49, you got to do it now. If you're not going to maintain that option, if you want to wait it out, then and you decide later to add, it's going to be $97. It's worth multiples of that, in my opinion, the way that we look at all of these things. If you get one good sort of concept out of something here that I put in the trade newsletter, that probably pays for multiple months. So just think of it that way. We also do a Wednesday update, or I do a Wednesday update with this. I do the newsletter. I do a lot of more analysis, metrics, all of this other stuff that comes in, and that's clearly adding more value than a lot of other services you get for a much higher price, in my view. So if you're interested, take a look. That's where you'll get that. And if you want to contact me, just email me, keith@tradeacademy.co, and I'm always happy to respond. That's the easiest way to get a hold of me. But if you want to talk, call me, 312-600-8004. I'm available. I'd love to talk to you guys if there's any questions you have about the Harwood Report or just trading in general. All right? Have a great afternoon. Look forward to having you all on for the newsletter. It's already posted. It was posted a couple hours ago. You get it earlier than the video. And hopefully I'll see you guys all for that and the Wednesday update. Have a great afternoon.